Hello and welcome to Asking for a Trend. I'm Julie Hyman, and for the next half hour, we're breaking down the trends of today that'll move stocks tomorrow. There's a lot to keep track of, so we're focusing on what you need to know to get ahead of the curve. Here's some of the trends that we're going to be diving into. A slow day for markets, with each of the major indices rallying into the green just before the close. We'll dive into the rest of today's market trends. Then President Trump's newest trade war has executives concerned that supply chain disruptions will get worse before they get better. We'll explore the results of Rapid Ratings' annual risk survey. Plus, Formula One racing celebrates its 75th anniversary this year. We'll hear from one of its newest drivers. Rapid Ratings releasing a new report surveying executives and experts about the global supply chain in 2025. And according to the report, a majority think supply chain disruptions will get worse before they get better. For more, we're bringing in James Gellert, Executive Chairman of Rapid Ratings. James, it's good to see you. So I guess, first of all, we should say that supply chain disruptions are ranking among the highest risks for 2025 in the eyes of the folks who took your survey.
Yeah, absolutely, Julie, and it's good to be with you again. There's no question that supply chain has been on everyone's minds, and certainly every company with any kind of global footprint, whether they're buying from or selling to outside of the U.S. But what we found really interesting in our survey this year is that when asked to rank the biggest risks that people saw, they listed geopolitical risk, tariffs, and economic unrest as the top three. And that's particularly interesting in the light of supply chain over the last probably 5 to 7 years, where you would have always seen cybersecurity risk as being one of the top two. So the fact that that has sort of slid down, it's now at number 4, and these other aspects, which are really all about trying to understand the challenges of the business environment and the cost base of companies and suppliers due to tariffs, interest rates, inflation, and so forth. All of these are on everyone's minds.
Well, and in the case of something like cybersecurity, you hire a cybersecurity firm, right? And I mean, you don't know where the threats are coming from, and it doesn't mean they're all going to be managed, but there is a remedy. In the case of the supply chain disruptions, nobody knows what's coming. So how are these companies modeling and managing that risk?
Well, every major, but let's just say the Fortune 1000. The Fortune 1000 have supply bases that span from domestic to international companies. And interestingly, about 75% of all of those companies' supply chains are made up of private companies. That may not be by spend, but it could be by criticality. So companies that have a big impact on the reputation or revenue disruption or the ability for a company to function well and properly. And managing the risks in those businesses often comes down to focusing on the financial health of them, because the financial health of those suppliers is what drives their ability to manage the risks like cybersecurity risk, or allows them to be a good partner in innovation and product development and the delivery of quality products without faults and on time. And all of these are very important historically in supply chain, and even more now. But when you start to throw on the risks of disruption to those suppliers from tariffs and high rates and continued inflation, you start to have these weaknesses that build up in supply chain. So the Fortune 1000 are trying to get ever more mature and sophisticated in how they manage those risks and how they look at each one of those suppliers to make sure they've got the most resilient supply chains possible.
Well, and then in turn, James, it's your job to look at these companies and see which of them is most at risk. You know, they're assessing the risks, and then you're assessing their risk level as well. So from your work, what have you found in terms of, are there particular industries, are there particular geographies? What areas do you think could potentially be most at risk from these types of disruptions?
Well, interestingly, with the risk of tariffs and counter tariffs and line item tariffs in particular, you've got the challenge that every industry is at risk. And we've seen, and through the survey, we found 81% of companies said that they have had a supply chain disruption in the last 2 years. And 30% of those disruptions cost the companies $5 million or more. And our clients span over 25 industries and are all global. So the companies that are being affected by all of these economic challenges and geopolitical challenges are really very widespread. it's too early to see if there's going to be a winning industry. There certainly are some countries that are seeing an upsurge in the reshoring of business from, let's say, China, where clearly there's a tariff interest by the current administration, to countries like, say, Vietnam.
Right.
But even then, there's the risk that that more tariffs get put on goods that come from China through another country. So no one is yet saying that there are winners and losers here. And generally speaking, in a trade war, there are no winners. There are just degrees of losers.
Well, speaking of degrees of losers, just quickly here, you pointed out to us that bankruptcy rates climbed last year. Do you expect them to climb further this year as a result of all of this?
I do. I think we'll continue to see them increase globally, and we'll also continue to see restructurings increase. Last year we had a 2-to-1 restructurings to bankruptcy rates, usually about 1-to-1. So the fact that more companies are proactively engaging with those who have lent them money is a pretty interesting sign. But you've got to keep in mind that we're coming off of still, a decade or more than a decade of very cheap and relatively easy money for most companies to borrow and paper over problems that they may have operationally. And we've seen in our financial health ratings a significant decline, particularly in private and middle market companies that have been squeezed from operational standpoints and from cost of capital, cost of labor, cost of goods. And all of those things ultimately add up to a lot of stress in a lot of these companies that need to be identified in one's supply chains to make sure that the end downstream Fortune 1000 companies remain strong and resilient.
James, thanks a lot for your perspective and for sharing those survey results. Appreciate it.
Thanks, Julie.
We've got some breaking news now from billionaire investor Bill Ackman, the CEO of Pershing Square Capital Management, announcing on X he is submitting a proposal to Hughes Holdings to acquire 10 million newly issued shares of the company at $90 per share. And he's raising a previous bid made in January, which was $85 a share. This is an effort to build what Ackman calls a modern-day Berkshire Hathaway. And if the transaction goes through, Pershing Square will own 48% of the Texas-based real estate developer. Ackman says he'll become chairman and CEO of Howard Hughes if the deal goes through. Shares of Howard Hughes, they did spike ahead of the close on speculation that this would be the target here. They were up by 7% during the regular session. Now that it is confirmed, they are falling by some 5%. Well, U.S. stocks closing higher with the S&P 500 rising to a fresh record close. Yahoo Finance's Jared Blick rejoined us now with the trading day takeaways. What Ryan Dietrich called earlier a boring record.
It was. You look at the price action today, it looks like the indices went almost nowhere, but it was just enough to get a record closing high in the S&P 500 and the NASDAQ 100. I'm talking today about distressed tech, though, so not even the NASDAQ 100. We're going to get to that in a second, but I just want to show you there is no more distressed tech than Chinese tech. These are our leaders year to date. I know there's a lot of funny symbols. A lot of these are ETFs, but if you just look up in the upper left, that is KWEB. That is Chinese tech, the internet ETF from Crane Shares, that is up almost 22%. After that is ARK, the ARK Innovation Fund. That's up 17%. And you take a look inside. Well, let's take a look at the NASDAQ 100. As I said, that was at a record high today. You're going to notice year to date, there's not necessarily a lot of participation among some of these big guys. You go over to the ARK components. All right, count out Tesla. That has not done that well this year on a net basis, but a lot of price action, a lot of outsized returns in here. So my point is we're seeing a lot of sideline tech just kind of exploding right now.
Well, it's interesting, I guess, while people might be taking on more risk in that sideline tech, they're also looking for safety.
Safety, why? Yes. What would that be? Dollar and the gold. So let's break that apart. We got the Global Fund Manager Survey from B of A today, and here's a question they asked investors controlling $500 billion in assets. What are the top currencies that investors expect to outperform this year? US dollar is up top, that's 31%, but that is coming down from the high 30s. Japanese yen, that is rising, that is now 30% on on the verge of taking over. Then we have gold. Yes, gold is a currency. That is getting 25% of the vote, and that is also increasing a lot. And I just want to show you what gold has been doing today, because it closed at a record high, and we've seen gold closing at records pretty consistently. So I'm looking for GC equals F. It's up 11% this year, and here we go. Let's do the year-to-date chart, and you can see, there we go. This is today's close right here, good enough for a record. Very, very close, within 50 bucks of 3,000. So gold making a comeback here. And I just want to point out one more thing. Who's buying gold? That would be the central banks. And I have, this is what central banks have been doing since 2010. It has been outsized the last few years. You throw a trade war in there, oh, you got something interesting.
Oh, no wonder people are buying. Let's talk about other commodities as well. What are we seeing there?
So we got commodities are kind of mixed. I'm going to go back to our commodities heat map, and we'll just cycle through this fairly quickly. We've had some winners and losers. I would point out that this is the time in the business cycle when you tend to see commodities outperform. We've seen a huge run up in coffee. That's still holding on to gains of 25% this year. That's 25% right there. HG is copper. That has been down the last few days. Let's put a 3-month chart or a 2-month chart on that, and we can see, there we go. It's not the picture I was looking for, but here we go. Here's the last 3 days. Net down. So we've had some mixed action, but you take into consider everything that's happened. You know, it's not OJ. OJ has been absolutely dismal over the last year. You can see this just fell apart very recently. So a mixed bag with respect to commodities, but we get the Fed cut one more time, or some inklings that the economy is turning just a little bit, but not enough to recession. I think we're going to see most commodities kind of explode to the upside.
Interesting. We'll see. And depending on dollar action,
it's all
too.
if, and it's a big bet with the Fed, so we'll see.
Oh, we got it.
Oh, yeah. Thank you. Thank you.
Hearing my ear fist bump cue. Stick around. We're asking for a trend on the other side. Occidental Petroleum and Devon Energy reporting their fourth quarter results. Oxy's adjusted earnings per share topping estimates. It also signed 2 divestment packs for $1.2 billion for the first quarter. Meanwhile, Devon Energy raising its quarterly dividend as company-wide production in the fourth quarter topped estimates. Here with more on the energy landscape, Tortoise Senior Portfolio Managing and Managing Director, Rob Thummel. Rob, it's great to see you here. So interesting to see these stocks trading how they are. I guess, you know, in a lot of cases, it's all about cash return. Is that why Devon's gaining here and we're not seeing the gains for Oxy? Just give us kind of your top level thoughts.
Yeah, it looks like it, Julia. So it looks like big picture in the oil and gas space right now. It's all about capital discipline. It's about returning cash to shareholders, because most stocks, including these two you were talking about, Occidental and Devon, have high free cash flow yields, greater than 10%. You know, if you think about that, that's a pretty high free cash flow yield relative to the market. That's probably less than 5%. So these are always attractive stocks from that perspective. Today, or what's factoring today, it looks like that Occidental's capital spending might be a little higher than what the street expected. So we'll hear more about that tomorrow. Higher capital expenditures actually brings down that free cash flow yield a little bit for Occidental. So that's probably the biggest reason why you're seeing a little bit of after hours negative, I guess, performance on the Occidental stock relative to Devon. Is trading pretty well.
Oxy is down 18% over the past year, which is interesting given that this continues to be a favorite of Berkshire Hathaway and of Warren Buffett, who keeps adding to his stake in the company here. What's been behind that decline, and would you be following Buffett into those Occidental shares?
Well, I think it's paid off over several decades to follow Buffett. So, and you're right, he has been buying, and Berkshire continues to buy more Occidental. I think they're up to a little almost 30% ownership now. Why is the stock decline? Well, the commodity prices declined a bit, and so you've seen commodity prices lower than probably where they have been historically, at least in the last few months. And so that's contributed to a little bit. Other reasons, there has been a little bit of a sector rotation out of the more cyclical, more commodity-sensitive stocks, maybe into tech or maybe even into other areas of energy that are a little less volatile. And so I think that's why you've seen that happen. Look once again, Occidental is still a 10% free cash flow yield. It's got a little bit of a dividend yield, 2% dividend yield or so. It's lowering its debt, so it's still an attractive company to look at if you're looking at oil and gas companies and the opportunities going forward. I think what we've learned in the last maybe 5 years or so, that oil and gas is here to stay. It's going to be a significant part of the future if the global economy is going to continue to grow.
Well, and on that front, I also want to bring up Diamondback Energy, which is doing further expansion in the Permian Basin with a $4.1 billion acquisition of some more assets in that area. It's already the biggest exclusive Permian producer here. Is all of the Permian buying done at this point? Like, how much more can you move the pieces around?
Yeah, that's a good question, Julie. So you gotta like Diamondback Energy. First of all, for its ticker, it's a very interesting ticker. It's FANG is a great ticker. So, and I hope it stays around a while. But the reality is you're right. There are still some opportunities for consolidation. Exxon, Chevron, ConocoPhillips, Occidental have done lots of big deals in the Permian Basin over the last year or so, or last couple of years. And Diamondback so far has resisted and basically have been buying their own acreage. So what they're doing today and what they've done historically is effectively get a larger position asset base, basically. So buying acreage that's close to them or that's right next to their existing acreage. Why do they do that? Well, it's because it makes them more attractive to one of these larger players someday if a larger player wants to come in and buy a large acreage position like Diamondback has. Believe it or not, oil and gas producers are producing more oil and gas, but they're also continuing to produce oil and gas more efficiently. So they're lowering the drilling costs. They're lowering the completion costs. So all that means is the break even for oil and gas producers continues to go lower. That's a good thing, I think, in the grand scheme of things, in a world where where the U.S. needs to produce more energy, the world wants more U.S. energy, but we need more low-cost energy to keep inflation low and keep commodity prices at a reasonable level for consumers.
Yeah, it seems like for these energy companies, it is a necessary thing to get those break-evens down if you've got a president telling you he wants you to produce more oil, Rob. Great to catch up with you. Hope to see you soon.
Thanks, Sheila.
For our chart of the day, we're taking a look at cash levels. Bank of America's Global Fund Manager Survey, it looks like cash is popular, right? Or not popular. I've got it backwards. Yahoo Finance's Alexander Canal. Set me straight, please.
Yeah, cash is not king, Julie. According to BofA's survey, cash levels have fallen to 15-year lows as traders double down on equities. So this signals a lot of bullishness surrounding stocks, the desire to really stay in this market. And this comes despite a lot of uncertainties out there. We have tariffs, inflation, other global trade risks. Typically those risks, that volatility, potentially push investors to keep some cash on the sidelines, but clearly not in this environment. So if we take a closer look at this chart, this is the level that fund managers have allocated to cash. We're sitting at just 3.5%. So this is the lowest level again since 2010. And that's driving up investor sentiment when it comes to equities and global growth expectations across the board. For where investors and these fund managers are putting some money to work, that's coming from, no surprise, big tech. BofA saying that long Magnificent Seven remains the most crowded trade according to this survey, followed by the US dollar and crypto. Of course, big tech hasn't entirely been the brightest star to kick off 2025. You're looking at the year-to-date gains and losses so far this year. Meta, the only Mag 7 name to outperform the benchmark S&P 500. We're seeing shares up around 22% since the start of the year. But with markets broadening out, yet another record high for the S&P 500 today, it's clear that bullish market sentiment remains intact. So if you have some cash, you're wanting to put it in this market, Julie.
Allie, thanks. Stick around, we got much more Asking for a Trend still to come. All 20 Formula One drivers and their 10 teams are in London tonight to kickstart the 2025 75th anniversary season with a new live launch event, showing off each of the vehicles that will be racing this season. Joining me now, Yahoo Finance's own Prospermanian to talk to us about what to watch for.
Yeah, so Julie, for the first time ever, they're showing all these teams at the same time. This is, of course, the brainchild of Liberty Media, the owners of F1, kind of bringing the sport to the fans more so than before. Speaking of which, Ford, which is now joining F1 with Red Bull next year, invited new Red Bull driver Liam Lawson to meet fans at the Performance Center in Charlotte, where I was at. I had the chance to talk to him about joining one of the top teams in F1 and also taking on teammate and F1 world champion Max Verstappen.
As a driver, it's the biggest opportunity you can have going into a top team that's capable of fighting for world championships. It's obviously, as a driver, that's what we're here to do. So for me, it's a great opportunity.
With Max Verstappen now, your new teammate, Obviously, he's one of the best drivers potentially of all time on the grid right now. What is your mindset going into racing against a teammate like him?
I think it's more, to be honest, the opportunity of being alongside him. Obviously, everything in the team is shared, so our data between cars is shared. We come in from a session, we debrief together. The setups, between both of us are going to be shared as well. So, as a driver, to have him as a teammate, to learn off him, as much as he's going to be very, very hard to match, he's somebody that, if there's anybody that's going to be good to learn off, it's going to be him.
And most people who know Liam and Max Verstappen have seen the two on the popular Netflix show Drive to Survive. I asked Liam about that Netflix effect on the sport and the U.S. as well.
That's been really, really cool to show fans, I think, to anybody watching in before that. You didn't really get an insight. You saw what happened on a race weekend, and that was really it. So I think it's given a really good insight to our lives and to what the teams are going through. And I guess the amount of people, the amount of effort and work that goes on in the background, it's done really well. It's grown, especially in America. It's something that I spend a lot of time here now, and I can feel sort of it growing around and sort of people becoming really interested, and obviously we have more races here as well. So yeah, it's exciting.
Races in the U.S., Austin, Miami, and of course Las Vegas becoming marquee F1 events. And this goes hand in hand with U.S. F1 broadcasting rights, which Netflix, Amazon, and others are looking to bid on at the end of the year.
Well, and what's going to happen with the rights, and are there sort of front runners to get all of that?
So ESPN currently has the rights. I think it's $90 million a year, but reports suggest that they are actually going to not renew. And for whatever reason, thinking maybe the cost might be too high. And that's why the Netflix of the world, even NBC Sports, but also Amazon, looking at those rights, it would be a game changer for all these races to be online, as opposed to a hodgepodge of various local broadcasts across the globe. One sort of portal will be pretty interesting for Netflix or for F1. And then how much money are they going to get? It's going to be bonkers.
Well, we'll count on you to keep us updated on that. Should be fun. Thanks, Ross. That's a wrap on today's Asking for a Trend. Be sure to come back tomorrow at 4:30 p.m. Eastern for all of the latest market-moving stories affecting your wallet. Have a great night.